Welcome to Mauuak Saving Tips-Want. You ever looked at the stock market and thought, how on earth do people know which stock to buy? You're not alone. For beginners, choosing the right stock can feel like trying to find a needle in a haystack. There are thousands of companies, all claiming to be the next big thing. But here's the good news. You, Dan T., need to be a Wall Street analyst to start investing wisely. All you need is a step-by-step approach, some basic tools, and a little bit of patience. In today's video, we're going to demystify the process and break down how to choose the right stocks as a beginner. Whether you're starting with $50 or $5,000, this guide will give you a simple, repeatable process to follow. No guesswork, no hype. Let's start with step 1. Know what you're investing in. One of the biggest mistakes new investors make is buying stocks they daren't understand just because they heard a tip or saw it trending online. Instead, take a look at the world around you. What brands do you trust? What products do you use daily? If you're using Apple, watching Netflix, or ordering from Amazon, you're already interacting with companies that could be worth investing in. This approach, famously used by investing legend Peter Lynch, is about investing in what you understand. Step 2. Understand the business model. Once you identify a company you're interested in, dive into what they actually do. How do they make money? Is it through selling products, offering services, or both? For example, Nike sells athletic gear. Simple, but Google. It makes money primarily from ads. Understanding how a company earns its revenue helps you decide whether it's a sustainable business or a short-lived trend. Now for step 3. Look at the company's financial health. Don't worry, we're not going to throw you into spreadsheets. You only need to focus on a few key numbers: revenue, net income, or profit, and debt. A good sign is consistent growth over the last 3 to 5 years. Also, check the PE ratio, price to earnings, to see how the market values the company compared to its earnings. If a company has a much higher PE than its competitors, it may be overvalued. Step 4. Analyze the company's competitive advantage, or moat. Think of this as the thing that makes the company hard to beat. Apple has brand loyalty. Amazon has an unmatched logistics network. Coca-Cola owns a secret recipe and global distribution. A company with a strong moat can survive tough times, beat competitors, and grow steadily. Ask yourself, what makes this company different from others? Let's go to step 5. Check the stock's historical performance. Head over to Yahoo Finance or Google Finance and look at the 1-year and 5-year stock chart. You don't need to be a technical expert to look at whether the stock has been growing steadily or if it's been a wild roller coaster. Consistent upward movement is usually a good sign for long-term investors. If there's a sharp dip, find out why. It could be an opportunity or a red flag. Step 6. Listen to the news and management. Check recent earnings reports, news headlines, or even YouTube interviews with the company's CEO. What are they planning for the future? Are they innovating, or are they cutting costs because they're struggling? Management matters, especially in today's fast-changing market. Now comes step 7. Diversify your picks. This might be the most important rule for beginners. Never put all your money into one company, no matter how promising it seems. Instead, spread your investment across different industries: tech, healthcare, consumer goods, finance. That way, if one sector underperforms, your whole portfolio doesn't collapse. Diversification is your safety net. Finally, step 8. Think long-term. Don't obsess over daily price changes. Stocks are long-term assets. The best investors hold their positions for years, not days. If you've done your research, believe in the company, and understand the business, you'll be more confident when markets get shaky. Let me give you a simple real-life scenario. Imagine you love Starbucks. You drink their coffee, love the brand, and you've noticed their expansion in cities and airports. You check their financials: steady revenue, good profits. You learn they're investing in international markets and digital ordering. You compare it to competitors like Dunkin' and McDonald's. And finally, you see the stock has steadily grown for 5 years. That's the kind of thoughtful process that turns a regular coffee drinker into a confident investor. To recap, here's your beginner-friendly stock picking checklist. Start with companies you understand. Learn how they make money, review key financials, look for a competitive advantage. Study long-term stock performance, stay updated with news and management direction. Diversify your investments. Commit to long-term growth. Stock picking isn't about luck or finding the next big thing. It's about strategy, patience, and discipline. And most importantly, it's about building confidence in your financial future. If you found this helpful, give it a thumbs up, share it with a fellow beginner, and subscribe to the channel for more investing videos just like this. And let me know in the comments which stock are you planning to analyze next. Stay smart, stay curious, and invest with purpose.